CMQ. Welcome back to CMQ Investing. My name is Chris Franco, and in this video, we need to examine this idea that Nvidia's rapid rise is an indication that we are in a new dot-com bubble. This is something I just read on Axios. It says that if AI is a bubble, it's making the dot-com bubble look small. Really? Okay. This is not only Axios that's been doing this. The Financial Times, in an article published on Valentine's Day just a little while ago. Happy late Valentine's Day, by the way. I love you. You do not have to love me back, but I would appreciate it if you would, if you'd like the video and subscribe. It means a lot. It goes a long way. And leave a comment as well. I'd love to hear from you guys. So this chart compares Cisco's price per share versus Nvidia's price per share, and it looks at Cisco's from 1996 beyond the dot-com bubble and Nvidia's from 2020 to present day. And without getting too, I guess, mean, if you're going to present financial data, this is a really dishonest way to do it. It's crucial that you maintain consistency, not only in scale, but in the time frame. Otherwise, you're just trying to make a point with statistics, not actually letting the statistics speak. Something that I've observed reading about the dot-com bubble is that many of the companies that were really driving it were terrible businesses. I don't mean they didn't have great ideas or they weren't exciting, but they weren't making money. A lot of times they were burning cash. Some of them didn't even have business models. And if you consider that, and then you look back at something, or look to now with Nvidia, I mean, it's not comparable. It could be something, but it's not the same thing. And it's just because people are like, ooh, tech stocks go up. Ooh, people excited. Ooh, must be the dot-com bubble. At the bottom of this New York Times article from 2000, it says that the endearing Pets.com sock puppet is a fitting mascot for the demise of the dot-com mania. Less than a year ago, the spokesdog for the online pet supply retailer was starring in some of those $2 million Super Bowl commercials.
Today, I'm talking to some city pets. Ooh, ooh.
And now, in the wake of his master's bankruptcy, he's looking to shill for another company, one that can actually make money. Nvidia makes money. Nvidia generates cash flow. Nvidia does share buybacks. You know, there's lots of things that make Nvidia a different type of business than a lot of these companies that you could look to as sort of the darlings of the dot-com era. Now, on Goldman Sachs' website, they have an article about the dot-com bust. And it says down here that the NASDAQ index rose 86% in 1999 alone and peaked on March 10th, 2000 at over 5,000 units. The mega merger of AOL with Time Warner seemed to validate investors' expectations about the new economy, and then the bubble imploded. Now, this is the important part. As the value of tech stocks plummeted, cash-strapped internet startups became worthless in months and collapsed. Let me just go back to that. Cash-strapped internet startups. Okay? This is not what we're talking about in this current era. You know, Nvidia is one example of that, but there are other companies. Let's look at the Magnificent Seven. These are not cash-strapped businesses. These are companies that are flush with cash and they gush out cash. It's very different. Next article here from the year, it must be the year 2000, but it says the article is more than 23 years old. And it goes down a little bit farther. I want to call this out, which is that most dot-coms were involved in sectors where profits, assuming there were any, were destined to be squeezed by cutthroat competition. Now, Nvidia's profit margins right now are very, very, very high. Is there going to be competition eventually? Yeah, I think that's fair to say. But are there also barriers to entry? Are there barriers to competition? Absolutely. From everything that I've read about the type of GPU or the type of chip that Nvidia is making so much money on right now, it's very labor intensive and it's very cash intensive if you want to go create your own. Now you'll hear, oh, what if Google, does that internally, or, what if Meta decides to make their own instead of buying from Nvidia? And that's all possible, but that's not happening right now. So we have to live in the present. And this is not something where you just, hey, we're making, AI chips now. It's not as easy as that. Doesn't mean it can't happen, but it's just different. Most dot-coms, again, were involved in sectors where profits, assuming there were any, just think about that. And so going back to that Axios point, hey, if AI is a bubble, it's making the dot-com bubble look small.
You suck.
Now, one last article I want to call out or point out is from the Wall Street Journal. And this is actually kind of echoing my bigger point. And towards the bottom here, it says, and it's referring, by the way, to the larger rally that you could include with the Magnificent Seven. This is not just about Nvidia, but it says that one reason why this rally might lack the boom and bust nature of the dot-com bubble, the beneficiaries of artificial intelligence were the stocks already shining this year. Investors were flocking to big tech in the first quarter, seeking shelter in strong balance sheets and cash flows. Again, a very big difference between these dot-com companies. Tech companies are also benefiting from the expected end of the Federal Reserve's interest rate campaign and resilient consumer spending. Cyclical sectors of the broader market have begun to catch up now. The recession fear. Okay. And this quote right here says, it's not like 1999 when investors were racing to hot IPOs for companies that had no chance of making money. Today's winners are disciplined, enormous companies that have moats in place and data sets to exploit.